Welcome back to class number 3 in total Fibonacci trading. In this particular class, we're going to be talking all about targets. Targets specifically for our entries and targets for our stops and even targets where we're going to take our profit off the table. And to do this, we're going to be using 3 specific little tools. We'll use the Fibonacci support and resistance tool that you're already familiar with. We're going to use the Fibonacci extension tool to look at our retracements, which you're also already familiar with. And then we're going to talk about using confluence to establish our targets. And so we're going to build on each and every one of these. They should be familiar to you. You should be used to working with them a little bit, but we're going to take it to the next level. What I want you to think about as we work through these next few slides together is this question here. Where should the market be trading and where should it not be trading? Think about that for a second. How different would your particular trades be if you could answer accurately every single time where should the market be trading and where it should not be trading in a particular perspective or framework? So it might sound a little bit in your trading plan like if the market is bullish or is going to remain bullish, it should be trading blank and it should not be trading blank over here. Or if the market is going to be bearish or going to remain bearish, it should be trading here and it should not be trading over here. It's a simple concept to think about, but when we start applying it in our charts, somehow it can get all jumbled up and kind of gnarly. I'm not going to go into great detail about this right here, but I did teach an entire video on this in the Fibs and 4 series. So it's class number 1, video number 6, and I don't want to duplicate content for no reason here. So if you're interested in understanding that trading matrix a little bit more in those Fibonacci target zones, go watch Fibs and 4, class number 1, video number 6, and we'll talk all about that there. For now, though, let's jump in and start doing some of our targeting. Here's a graph of the euro dollar. So if you're one of my foreign currency traders, this should look very familiar to you. If you're a stock trader, no big deal. It's very, very similar. We're just not going to have as many gaps, and we may use some of the wicks a little bit more in the foreign currency than we would in the stock market. To begin things here, I want to use a tool that we started off with way back in class number 1, and that's the retracement tool. And we're going to draw starting on the right-hand side on this big, long, dark candle. We're putting our 50% line right in the middle of a nice, good-sized move from the euro dollar. And then we end our range where this whole thing got started to begin with this nice, long, white candle there. Remember in class number 1, we said it should feel a little bit like a sentence. It starts with some capital letters, it's got some punctuation in the middle, and then we've got a period or an exclamation mark at the end. Do we have all those elements here? We've got a capital letter to begin with, we've got some punctuation in the middle around the 50% line, and then we've got the big old exclamation mark right where this whole thing began originally and where we're ending our range drawing. And as we can see here on this chart already, it looks like the price came right on down, it bounced off the 50% line, and everything's great, right? Well, until we advance one slide more and the whole thing fell apart on us. I mean, can you believe that I would put this slide in a video presentation nonetheless? It's all supposed to look easy, right? Or easier. We're not trying to make this complicated as we're learning it. Well, here's where we can expand on the knowledge that you already have. In class number 1, remember, we talked about how Fibonacci ratios are both additive and multiplicative. And you can get really nerdy and kind of math nutty on me if you want, but really what that means at its essence is we're able to subdivide down into smaller and smaller fractals. And so I would suggest that we could take this range between the 618 retracement all the way on down to the 100% retracement and subdivide that even further. And if we do that and snap a Fibonacci retracement on there, we can see that it looks like from what we've got so far that we're respecting that 50% subdivision. Let's advance a little further, and sure enough, we came down just a little bit further. We got on down to the 61.8% subdivided retracement, and then of course the euro dollar took off, as you can see on the right-hand side of your screen. Remember, what we're trying to answer right now is where the market should be trading and where it should not be trading. And we're using this information to understand where we want to get into and where we would want to get stopped out of trades. So if we were looking at this, we may want to color code the euro dollar as follows. Perhaps we did get excited about jumping into a trade right here on that 50% line, and we would want to know, where should we place our stop? Well, you certainly wouldn't get any pushback from me if you wanted to put your stop somewhere in this yellow box. That's not a bad idea. But we do need to be aware that it's a possibility that we could trade down into that yellow box and continue on our way, because it's just a subdivision of that larger Fibonacci fractal. Now, it gets unreasonable to continue subdividing. We get to a point where we got so many lines on the screen that we don't know what to do with. So, when things start to get a little bit tight, that's time to call it quits. And I have found very, very few instances where more than one additional subdivision is possible, let alone necessary. And so in this particular case, if we get down into the yellow here, that's kind of borderline. Yes, we're still bullish. It makes sense that we've come down and we're bouncing in this yellow box, but that's borderline. And if we get below that yellow box, which is basically from the top of that 618 original retracement on down to the bottom of our subdivided green lines, if we get much below that, this is kind of a no-go for me. Certainly if we get below our 100% retracement, then obviously something has changed. The market's making a new low, and we're going to continue on in that direction most likely. Make sense? And so in this particular case, you'd want to be thinking about stop placements maybe in the orange or in the red, and you would probably still be comfortable seeing the stock, or in this case the foreign currency, come down and bounce in the yellow. You see the bounce, that would be an opportunity to get into a trade. And so what I want to encourage you to do as you're looking at this and saying that may be an opportunity to get into a trade is to put on a different hat for a second. So we've kind of got the bullish hat on right now, and we're thinking that yellow box may be a good opportunity to get into the trade. But force yourself to be a contrarian and say, what if I had my bearish hat on? What if this thing really is bearish right here, and all we're going to do is come and bounce on up a little bit, and this is heading on south? Wouldn't it be good to know where those points might be, where you'd have confidence that the bearish trade is in effect? And I'm not suggesting that you're taking a bearish trade right here. What I am suggesting is, before you get into a bullish trade, it would be a pretty good idea to make sure that there's not an opportunity for a bearish trade to show up and surprise you. Let's just put that to bed, and then we can feel a little more comfortable getting into our bullish trade. So there's a few retracements in here that we can identify. I'll circle them in red for you. Those were times where we came down. It looked like we may have found some support. It looked like maybe the bulls were coming in, and it was a good opportunity to jump into this euro-dollar trade. But what I'm suggesting is we can apply some of our knowledge that we just learned using these Fibonacci retracements and figure out where this thing should go if, big if the euro dollar was going to continue bearish. So let's come on up here to our first red circle right there. We're going to drop a Fibonacci support and resistance line on there, measuring from right there on back to the beginning of this whole range. And you can see that all that we've done, let's do it in orange here, is come on down, bounce, and hit a 0.382 retracement. That's it. We've just bounced exactly where we would expect to bounce if this was going to continue bearish. And it did continue bearish. So it would be foolish to get into a trade anywhere, really, in my opinion, below the 618 retracement from the bearish perspective. Does that make sense? Can you see what we're talking about there? I want to make sure that the bearish trade is dead before I jump into my bullish trade. Here's another example. Maybe it'll clear up things for you. This was a little retracement right here. I'll circle it for you in green. And we're going to measure our Fibonacci retracement. We're going to start right here where we've got the punctuation and capital letter, and we pull on back, and yep, we get our Fibonacci box right there. In fact, I'll just kind of highlight this in orange for you as we go across the top. And sure enough, we came right on down. We bounced, and you can remember there was a yellow box down here, so we found some bullish support, came up and bounced, and we're just right inside the Fibonacci box there. This has not yet told me that we're trading where we should not be in a bearish retracement. In fact, this is saying that it has all of the potential still to continue on bearish. So at this point, I'm not interested in a trade yet. It has to prove to me that there is no further opportunity that I can see for this thing to continue bearish. Then we'll pull the trigger. So let's do one last measurement here. Obviously, you can see that we started up this direction here. We found support. We bounced off our yellow box. Let's go ahead and measure from right here all the way back to the beginning of this range. So we're measuring right underneath that green circle. And sure enough, in a matter of 2 or 3 candles, I'll highlight it in red there. There's our Fibonacci box. We blew right on through it. And so now it's saying, aha! There is no more opportunity for this thing to be bearish because we're trading keywords here where we should not be trading in a bearish market. Well, it's a little bit of a double negative, right? But if we're trading where we should not be trading in a bearish market, then that's good for my bullish trade. I want to be trading where we should not be trading in a bearish market. See what I mean? And so here we go, we take off, and sure enough, we'd probably get kicked into this trade. You could either do it here, or you could do it right above that 0.618 retracement. Either one of those is fine, depending on your risk tolerance level. And play with it in your virtual trading. You'll get familiar with it. Sure enough, we start to pull on back. So right here, we have a little retracement. We could measure that as well. I just adjusted this slightly. We're actually measuring from there, 0.1, on down here to 0.2. We've got our little Fibonacci box in there, the 618, the 382, and the 50% cutting between the two of them. And on this little retracement, we didn't even get back to the 382 line. This thing is bullish all the way. So if we didn't get into the trade right here, surely as soon as we made a new high, we could jump into this thing. And how did it play out? Was our patience rewarded for waiting to see where the euro dollar was no longer bearish? Let's advance our chart. What you were able to see in the last screen is highlighted in red here, and where we went is on the right-hand side, and sure enough, right here is where we got into the trade, and this thing just took on off for about 4 months. It was a beautiful euro dollar trade. That's the power of understanding where we should be trading and where we should not be trading. It gives you clarity and optics on where to enter the trade. It gives you clarity and optics on where to get stopped out of the trade. And it helps give you some confirmation because you'll realize as you begin a trend trade that it is completely put to rest any notion that the alternative framework, in this particular case bearishness, it's put to rest that it's even an option anymore. Now, is it perfect? No. But it's really, really good. And if you could discipline yourself to only trading when the market's where it should be in the framework you want, and it's where it should not be in the framework that you do not want, then you're going to see your win-loss ratio skyrocket. Play with it a little bit, and I think you'll be impressed. That's enough for this video. Take a little break. We're going to come back and talk a little bit about targeting with extensions and also confluence. We're going to do that in video number 2 in class 3. So I'll see you back here in just a second. Get a drink, whatever you need, and we'll be back in just a moment.